welcome. You're watching Profit Insights on NDTV Profit. I'm your host for the show, Pallavi Nahata. Now, earlier today in the evening, figures for retail inflation and industrial output were published by the Ministry of Statistics and Program Implementation. While retail inflation came in at 5.09%, industrial output came in at 3.8%. So inflation was broadly in line with expectations, while industrial output was a tad below expectations. But let's have a quick look at some of the key inflation items. Now, cereal and product inflation was at about 7.6%. Inflation in eggs saw a rise in February, coming in at 10.7%. Inflation in vegetables too continued to rise on an annual basis. It came in at 30.25% for the month of February. Pulses continued to remain in high double digits, coming in at 18.9%. Clothing and footwear inflation came in at 3.14%, and core inflation, that excludes food and fuel, the volatile components, continued to provide respite to consumers. Now, moving on to industrial output, mining came in at 5.9%, manufacturing grew by 3.2%, and electricity grew by 5.6%. But for their insights on what they're making of today's figures, we're joined by Dhiraj, economist and FX strategist at ANZ Research, and Teresa, Deputy Head of Research and the lead economist at Nirmal Bank. Thank you so very much to both of you for taking time out for both of us. To begin with, what are your first thoughts on the figure? What are you making of the headline figures? Teresa?
So I think from the numbers that you read out, the food and beverage inflation, we were expecting actually a moderation to around 7.2%. So that remains at around about 7.7%. It's actually marginally higher than last month. So I think the vegetable prices probably have not seen any material fall, and probably the cereal prices also remain slightly elevated. This is not very different from what we are hearing on the ground, that probably the vegetable prices have not come off significantly, because unless the rabi crops actually kind of hits the market, particularly for commodities like onions, you may not see a big fall in food inflation. But I suspect the core inflation has probably moderated from last month's level, which is anyway very kind of benign at 3.6%. So yeah, the food inflation number seems a bit concerning. So if you do see a spike in food inflation in the coming months, so any reason, unseasonal rainfall, etc., then probably the possibility of rate cuts could get pushed back, because the growth numbers are still looking good. But I think core inflation being benign is still a source of comfort.
Absolutely, that's true. But Dhiraj, coming to you to talk about some of the specifics again, like we've touched upon vegetables inflation, that's at 30.25%. That's actually a tad bit higher than the figure we'd seen on an annual basis in the previous month. And even in terms of the sequential momentum, not much of a change. There, the index values are pretty much constant. Of course, Teresa mentioned that up until the Rabi harvest hits the market, we don't have much reason to expect much respite there. But is it a little concerning, considering we're seeing vegetables inflation at 30.25%, pulses inflation remains at 18.9%, cereals, of course, on an annual basis at least has come off by a tad bit, it's about at 7.5%. When can we, for vegetables, starting with that, when can we expect some respite, next month or the month after?
Sure. To answer your first question, I think the vegetable inflation is indeed high, and it is keeping the headline quite elevated. But if you're looking at the month-to-date data for March, it seems that there has been some kind of a sequential slowdown in vegetable prices. That is for both the sets, that is potato, onion, and tomatoes, the key vegetables in the basket, as well as the non-POT vegetables as well. I had highlighted this before that, some of the non-POT vegetables in the last month in February had gained momentum in terms of the daily prices, which is probably why this number is higher at about 30% year on year. But I think going forward, this number should start to ease, but falling from 30% would be a gradual descent. Now, in terms of cereals and pulses, it's both good and bad news. Look, pulses is also a kind of staple in India, right? So pulses inflation at 18% year on year is quite high, and we know that the pulses sowing situation and harvesting situation has not been very encouraging from an inflation perspective. So I think it begs for a lot more public policy intervention insofar as pulses inflation is concerned. And I think a number of steps have already been taken, and they are yet to show their full effect. As far as the cereals inflation is concerned, that is where I think a bit of a good news is, because it's falling, but gradually falling. I think cereals and pulses inflation, out of the categories you mentioned, are very important to shape household inflation expectations, which the Reserve Bank of India is watching very closely insofar as its monetary policy is concerned. So I think food inflation remains a divergent lot. As a whole, the food inflation is quite high. And I think there is some sense of vulnerability from the near-term shocks. So the Reserve Bank of India would be very keenly watching to what happens to Kharif harvest, the Rabi sowing, and to some extent the El Nino conditions and early predictions on monsoon before they feel confident enough to dial down their hawkishness.
Okay, so I'll just take up a couple of the points that you've mentioned. We continue to remain on wait and watch mode on several parameters where Rabi sowing trends are, for instance. Rabi sowing does appear a tad promising. We saw a weak start to the Rabi sowing season, but finally now we're seeing a little bit of a pickup for some of the food items. What are you making of the Rabi sowing trends at this point, Teresa?
Nearly at the point of the Rabi harvest, it's only a couple of weeks. So I just came back from Rajasthan a couple of days ago. The Rabi crop is looking good across most states. There has been some unseasonal rainfall in end of Feb, early March, but that has not affected the crop significantly, except in some parts of Madhya Pradesh. So the wheat crop is looking good. There are still 2 more weeks till the harvest hits the market, as I was saying earlier. So if this trend continues, you probably might get a good Rabi harvest, and then that might alleviate some of the concerns on at least on high cereals inflation. Kharif, the main Kharif crop is rice, so you'll have to wait for the Kharif crop to hit the market, which will probably be again 6 months later, that you'll see a meaningful moderation in rice prices, but at least wheat prices should not go up from here, at least from the early trends we are reading.
Okay, but help me understand something, Teresa. So, we've just spoken about Rabi sowing trends. For instance, the area sown under pulses is not very substantial during Rabi sowing. So, and looking at what the inflation picture has been so far, like Dhiraj pointed out, despite significant supply interventions, there's clearly scope and space for more measures. Would it be fair to say, when juxtaposed with the Rabi sowing trends data, that on pulses there is limited reason to expect respite going forward? Would that sort of be the right way to look at it for pulses?
Yeah, you're right, because you'll have to wait for the next crop. But as of now, the imports have seen a pickup. If you see on a year-on-year basis, the imports are quite high for pulses. And on a month-on-month basis, in fact, if you see the month-on-month movement in prices, I'm not sure about this month. I need to go to look at the data carefully. But on a month-on-month basis, over the last 2 months, we actually saw some moderation in pulses prices. So not that you will see significant respite, but prices may not go up significantly from here, is what my sense is.
Okay. So just to summarize that, while prices may not go up significantly from here, at this point there's limited reason to expect much of a downside as well. Would that be correct?
That's right.
Okay, all right. So Dhiraj, again, I know we're continuing to focus on food inflation, but I do want to ask you one more question before we can move on to some of the other items. not too long back, the IMD said that we could see the early onset of summers, and that's not worked out so well for us in the past. Like last year, there was a clear impact on agriculture for multiple food items. First, the early onset of summers, the heat waves, and then of course the variability in monsoons. So of course at this point it is a tad early to be able to reach a conclusion, but that's definitely something to be concerned about. Would you say that?
I think it's a structural concern. So in the sense that, even the Reserve Bank of India has acknowledged by the way of its research, and it's become a well-known fact now, that the vagaries of weather, inclement weather, has made the cropping cycles a little more haywire, right? Which has impact on food prices in every cropping cycle and in every harvesting cycle. So I think food inflation has acquired a bit of a structural element that we need to be worried about from a long-term perspective as far as the monetary policy is concerned. Of course, there would be warning signs along the way about weather, about rains, but we need to acknowledge that as of the information that is standing today, things are not looking as bad. So you're right in pointing out, for example, pulses, Rabi sowing is lagging a bit, but the trends have picked up off late. There is significant import, as Teresa said. But I also feel that a withdrawal of El Nino conditions will be very helpful. And if we do not get unseasonal rains, and I hope that happens, I think food inflation situation may remain under control. Look, the proof of the pudding is in eating, and I think the most important factor here, from the perspective of monetary policy, is to realize if food inflation and the headline inflation, therefore, is decelerating along the expectations that the RBI has laid out. If that goes as planned, then we may not be very, very far away from the RBI dialing down its hawkishness.
Okay, all right. Core inflation, of course, like we've mentioned, continues to bring respite. What's the trajectory going forward? And also before that, at this point, given, we recently saw GDP figures come in for Q3, private consumption was not particularly promising. Would it be correct to sort of read these prints that have been coming in over the past few months for core inflation that essentially excludes food and fuel, also as an indicator of slightly weakening demand? Teresa?
Yeah, so I mean, one of the reasons why your core inflation has been actually benign is because your petrol and diesel prices have not moved up, and so basically the moderation crude oil prices have helped to that extent. If you do, I mean, I think there was a broad expectation that there would be price cuts on petrol and diesel, which have also not panned out. So I would attribute part of that to the moderation in crude oil prices and the government keeping the petrol and diesel prices constant. But yeah, to some extent, it means slightly lower pricing power, particularly I would think, for the mass consumption basket of goods. But that said, I wouldn't read that. I mean, demand in many pockets of the country actually remains strong, but there are pockets where, particularly at the bottom of the pyramid, either inflation, particularly in the food basket, has actually acted as a deterrent for consumption in the discretionary basket, which some of it is reflected in the core inflation numbers.
Okay, and again, moving on to industrial output, fairly decent figures are those in line with expectations. The headline figures are 3.8% in January. So coming to you, Dhiraj, is this broadly along expected lines? We did see a little bit of a bump up post the festive season, post which industrial output continues to remain fairly benign. But on a fiscal year-to-date basis, industrial outputs actually performed fairly well so far. What is what's it looking like to you?
The first impression is that it's slightly weaker than my expectations.
Okay.
I was expecting a 4.5% growth in IIP on the back of growth in manufacturing. Before we go into any kind of reasoning, I just want to lay out very clearly that, look, the efficacy of IIP to gauge the health of manufacturing sector in particular may be limited because of various measurement issues that have been highlighted in the recent past. But if you marry it with a lot of other indicators, for example, the PMI manufacturing, and to the fact that the most recent GDP print pointed that there there is further recovery to be had in manufacturing sector because it's not yet reclaimed its share in gross value added. I remain optimistic, that manufacturing recovery will continue and it will contribute to the broader supply side recovery. Lower core inflation is an artifact of that, in fact, in my opinion, amidst weak consumption demand. So I do continue to think that India has yet to see a substantial supply side recovery in the coming quarters, especially in manufacturing, because its share in gross value added is not yet normalized as far as the historical viewpoint is concerned. So overall, while this month's figure may be slightly lower than my expectations, but let's be cautious of not overreading into 1 month's data as far as IIP is concerned. Overall, my outlook is that industrial recovery has further to go.
Okay, all right. But Dhiraj, just coming back to you, taking up from where you left, this has been the broad narrative for a while that in case of manufacturing, while there is some recovery post-pandemic, there is clearly some more road to be covered. What do you think are the deterrents at this point? Would you sort of come back to not so strong private demand as one of the reasons that continues to remain a drag on manufacturing?
I absolutely agree. So from a medium-term perspective, weakness in private consumption demand could be a deterrent on manufacturing growth and aggregate demand overall. But at the moment, I believe exports have been an important tailwind. Look, one point which remains sort of underappreciated is that export rebound has been faster than anticipated and earlier than anticipated. That could be perhaps contributing to, in some sense, in some shape and format, to the manufacturing recovery, and that may continue in the meantime. But I, of course, am cautious that private consumption demand is lagging and will have a negative impact on manufacturing sector, everything else constant. But we can expect some kind of offset from the investment demand, which is seem to be doing well. And alongside the government investments that we know have been very strong for quite some time now, we have seen some signs of private capex revival as well as far as the most recent GDP print is concerned. So I think there are some positives there in exports and capex revival, and of course there is that very important negative from the weakness in private consumption.
Okay, Teresa, coming to you, within the industrial output figures, consumer non-durables has actually seen a contraction, if I'm right, of minus 0.3%. So not a very steep contraction, but a fall nevertheless. This is after months of volatility in consumer durables and non-durables. Again, maybe as Dhiraj mentioned, is the figure possibly a one-off? Do we need longer term data to sort of see, be able to gauge what is happening in that space? Or do you think that that's again possibly a sign of consumption at this point? What do we make of the consumer non-durables figure?
So if you look at the core infrastructure industries data and the IIP data over the last few months, the sectors that have been contributing to the pickup, cement and steel have been actually been doing quite well, which is linked to the kind of capex investments that we are seeing, both primarily from the government, to some extent from the private sector. But consumer durables and non-durables, as you said rightly, has been quite volatile. So I mean, looking at 1 month's data, it's too much. I mean, it wouldn't be right to read into that minus 0.3% decline. But what you've seen is that in certain sectors like your food and beverages, over the last few months, we have seen quite a bit of volatility. And I mean, it's also linked that if you look at the data and the commentary from many of the companies, the FMCG volumes are yet to see a pickup. So this kind of, supports that argument that probably the consumer non-durable segment, has some way to go before you actually see recovery, and possibly that's linked to the rural recovery as well.
Okay, sure. So coming to rural recovery, moving on from the inflation and industrial output figures we've seen today, most high frequency indicators appear to hint at a little bit of a revival in the rural segment. For instance, figures came in for two-wheeler sales. The auto sales figures came in today, and two-wheeler sales seems to have performed particularly well. That, along with record high auto sales, and also we've touched upon Rabi sowing trends and a whole host of other indicators. fair to say that we are seeing some signs of recovery in the rural sector? Dhiraj, could you weigh in?
Sure, I think there are signs that the rural sector has bottomed out in terms of rural demand and rural growth. The indicators that you mentioned, of course, bode well, along with the fact that Rabi sowing has been looking encouraging for a couple of weeks. We do not expect inclement weather or El Nino conditions this year. We do think that agriculture as a whole and rural demand and economy as a whole could be bottoming out already. But let's be cautious that this is also an outcome of the fact that the wider economic growth and consumption has grown in a much more unequal manner in the aftermath of the pandemic. And this is not a problem just restricted to India, but across the board. So that unequal recovery in growth and consumption and incomes is also weighing on the overall consumption narrative. But within that, we are seeing some encouraging signs of rural recovery, but it is yet to get to a level where it begins to contribute solidly to overall consumption growth, is my reading.
Okay, so actually jumping on from what high frequency indicators are telling us, I do want to quickly touch upon bond yields before we can close the show. So India's benchmark 10-year yield fell to about 7% yesterday, about 50 basis points above the existing repo rate of 6.5%. We're seeing really small term premium at the moment. Teresa, what's the expectation? Is this a trend that you expect to persist in the coming months?
So there are two things. I mean, obviously, there is a lot of interest from FPIs that have come in over the last 2 to 3 months in the run-up to the bond inclusion that will happen in June. The other point is that if you look at banks' demand for G-Secs, that has been remained quite strong, despite the fact that the banking system liquidity has actually tightened. So there are a lot of tailwinds supporting bond deals at this point in time. And also markets are anticipating rate cuts. I mean, difficult to say exactly which month it will happen, but going into FY25, we are definitely expecting at least a 50 basis point of rate cut. So probably the term premium, from a historical perspective, it has come down, but maybe we are going into an era where the term premium will be structurally lower than what it was if you look at the 5-year or a 10-year term premium, because even if you look at the spread of Indian GSEC yields over US GSEC yields, that spread has come down very significantly. We are at 7% and the US is at around 4%. So and some months it's gone below 3% as well. On a historical average, it was 5%. So we are probably seeing some structural changes in way investors are looking at the Indian economy, supported by relatively strong macro fundamentals.
Okay, all right. Dhiraj, do you share the same view? And what are the implications of, as Teresa mentioned, possibly structurally lower term premiums than we have seen so far?
Look, I think the compression in term premium in India is reflecting a couple of things. So the first is, of course, the broadened demand from foreign investors because of index inclusion. And that's a structural tailwind, because of which I'm not very enthusiastic about, comparing the current term premium versus what was there in the past. So that broadened demand is actually a very, very important contributory factor. But if you separate that out, then term premium actually reflects inflation expectations in a way. How well do you think the central bank will be able to manage inflation? And I think the yield curve in India's case had generally been flat, could become flatter going forward because we expect more FPI money to come in. And as economic growth, peaks out, there could be some slowdown in credit demand, and that could contribute to higher appetite from bank side as well. I think there's a bunch of factors that are contributing for stronger demand for bonds. At the same time, I think the Reserve Bank of India is going to hold with its hawkish stance for slightly longer. I think my first rate cut expectation is in August 2024. So until then, we would have already seen the passive flows come in on account of index inclusion, which could lower the yield further and compress the term premium further for the Indian yield curve. So one also has to realize that even when the RBI gets to cutting rates, it's not going to perhaps indicate that it's a really deep rate cutting cycle. So the front end of the curve is not going to fall very much. I think at best they will indicate that it is to recalibrate the real policy rate in future so that it does not become growth restrictive. And to that extent, it could be a shallow rate cutting cycle. So I think a narrower term premium is here to stay. But as Teresa also mentioned, there are both structural and cyclical factors behind this.
Okay, well, with that, we're completely out of time. Thank you so very much, Dhiraj and Teresa, for taking time out for us today. So retail inflation came in at 5.09%, about 5.1% for February, while India's industrial production grew by 3.8% in January. While inflation was broadly in line with expectations, industrial production disappointed by a tad bit. That's all we have for you on this edition of Profit Insights, but stay tuned to NDTV Profit for more news and updates.